Clowns are funny.
Well, hello there. No, that's Chris's opening.
You should do that.
Hey guys, Raf here from the Endgame Investor, and today we're going to talk about how the short-term debt markets seem to believe that a temporary default is more likely than it has ever been. We're going to look at short-term debt markets. We're going to look at the spread between the 1-month Treasury yield and the effective federal funds rate. The difference, of course, is that the 1-month Treasury is paid ultimately by the Treasury, which is running out of money and has about $87 billion left. We're going to go into the exact numbers, and the effective federal funds rate is paid by one bank to another bank set by the Federal Reserve's overnight interest rate. So there's much less of a chance of default on the effective federal funds rate because it's paid by one bank to another. Whereas the 1-month Treasury bill has a much higher chance of default because it could be that the Treasury hits the debt ceiling and runs out of cash and is unable to pay a 1-month Treasury bill that's due in June. And we see in the market itself that money market funds that are invested in these 1-month Treasuries are avoiding June maturities because they are worried about default and affecting the money market funds that their investors are in turn invested in. We're going to go into the myth that is the narrative today regarding the regional banking crisis, that deposits from regional banks are flowing into large commercial banks. That is not true, at least not on net, and I'll show you the exact numbers that prove this. Because the truth is that large bank deposits are being evaporated at a rate twice as high as those in regional banks. Registered stocks of silver have fallen below 30 million ounces for the first time since 2016. More than half of institutional and retail investors say that in the event of a debt ceiling, a default of any kind, most of them, more than half of each group, is going to run to gold more than any other safe haven asset. And though gold seems to be having a pullback now, the gold to commodities ratio has been trending higher steadily since June 2022, and I don't think that is going to stop anytime soon. So we are in a commodities cyclical bear market right now, or a cyclical correction, or whatever you want to call it. I'm not a technical analyst, and the terminology doesn't really matter to me so much. But as the commodity complex continues to sell off slightly, gold is leading the rest of the commodity complex because the ratio has been heading higher for a year now. This video is brought to you by...
Why don't you let me fix you some of this new Mococo drink? All natural cocoa beans from the upper slopes of Mountain Nicaragua, no artificial sweeteners.
What the hell are you talking about? Who are you talking to?
Well, actually, this video is brought to you by US Goldmining Inc. And on a note about sponsorships in general, I have over 200 videos on this channel, and I get approached for sponsorships all the time. I turn down almost all of them. And when I accept a sponsorship, I'm not telling my viewers to buy. I am telling you that there is a stock out there that deserves your attention that might go up in the near future. When I get an advertising offer, I look into it, I ask around from people I know, people I trust. Do they trust this company? Do the people involved? And if I get satisfactory answers, then I will choose to accept a sponsorship. So in this case, those criteria have been met, and people, I think, should know about this company. First of all, as you can see here are the statistics on its main asset, the Whistler project in Alaska. You have here the indicated versus the inferred gold ounces in millions of ounces. Here you have 1.94 of indicated and 4.67 million of inferred. And the job of drilling is to turn the inferred into indicated, and that is what the company is going to attempt to do with its $17 million in cash. There is a second reason why this company deserves your attention. You can see here the ownership structure. An IPO of this company just happened a few weeks ago. You can see here before the IPO, 94% of the company was owned by Goldmining Inc. That is symbol GLDG. Before the IPO on April 19th, 2023, 94% of US Goldmining, USGO, was owned by Goldmining Inc., which is owned partly by GDX, the GDX ETF, which most gold miners know about, if not own. Now, you can learn more about the connection between Goldmining Inc. and US Goldmining. I'll put a link in the description below so you can know what exactly the interactions between those two companies. So now, post IPO, Goldmining Inc. owns about 79 to 81% of the total share float. 16% belongs to IPOs and 5% to insiders. And there is another wild card with USGO, with US Goldmining, And that is that if the stock can close above $20 by Friday, there's a chance that they will be included in the Russell 2000 index. And if they are included in the Russell 2000 index, which reconstitutes or reformulates its index on May 19th, starting on May 19th, reevaluates the stocks that make up the index, then the retirement funds that invest in the Russell 2000 index will automatically invest in US gold mining, which should bring the price higher. So you can make a decision. If you are interested in this company, you can wait until Friday to see if it makes the index, and if it does, then buy it, which would be less risky, or you can bet on whether they will make the index by Friday, in which case it would be more risky, but you get a higher upside. And of course, longer term, if they can turn the inferred gold resources into indicated, then the value of this stock gets more unlocked and the value should go higher. Of course, the decision is up to you. So if you do have a section of your portfolio dedicated to exploration companies, I believe this one is worth considering for that portion of your portfolio. Let's go to the slides. Slide 1 here, you see that the Treasury is down to $87 billion cash. This is as of May 16th, I believe. You can see here that yesterday, I think for Monday, the balance was at $139,944,000,000, where my cursor is mousing over right now. And the total withdrawals was $209 billion. So the new balance as of today is $87,431,000,000. And here below, I have a group of withdrawals here. And by far the biggest withdrawal yesterday for the Treasury was $50,971,000,000 in interest on Treasury securities. The total drawdown in deposits was just over $50 billion. So pretty much all of the loss from $140 billion to $87 billion was because of interest on Treasury securities. And because short-term Treasuries are so much higher than long-term Treasuries, the interest being paid by the Treasury every month is starting to spin out of control. And this is not a very good thing when you're down to your last $87 billion. Now, this is a chart that I configured for my subscribers on the Endgame Investor yesterday. This is the spread between the 1-month Treasury bill and the effective federal funds rate. The 1-month Treasury bill is paid by the Treasury, which is running out of money, which might run out of money by June 1st. And the effective federal funds rate is the rate paid by one bank to another bank that needs cash for overnight reasons, for regulatory reasons, and it's paid by banks and not by the Treasury. So there is basically no way that there's going to be a default on the effective federal funds rate or anything, because they're paid by private banks. Now here, this box that I put, this little red box I put here in 2011, 2012, that was the last serious debt ceiling debacle. And you can see here that the spread between the 1-month and the FFR is negative, meaning that the 1-month Treasury bill yield was lower than the effective federal funds rate, which meant that the market did not believe there would be any default on 1-month Treasuries, even during the last most serious debt ceiling debate, debacle, whatever, circus that we saw about 11 years ago.
Clowns are funny.
Right? The market did not take that seriously, at least by this spread. But now, look at what is happening here. The spread between the 1-month Treasury bill and the effective federal funds rate is going all over the place. It's been going all over the place since the middle of 2022. Right? It's like a EKG heart attack or an earthquake or a seismographic earthquake here. And it looks like the market has no idea what to expect or what to do. So we're now at, I think, about 0.71, which is an all-time record high, which means that the 1-month Treasury yield rate is at a record high relative to the effective federal funds rate, which means that money market funds are getting out of this stuff because they don't know if it's going to default or not. They're taking it seriously this time. And at the bottom here, I have a paragraph from a Bloomberg article that was syndicated in Yahoo, and I'll just read it, which shows you that indeed funds, money market funds, are getting out of treasuries, of 1-month treasuries that are maturing in June. So it says here, T-bills maturing after the potential so-called X date have been trading with a significant yield premium because of concerns about non-payment and continue to do so on Monday, with the most notable dislocations in paper due June. At the same time, the cost of insuring U.S. debt against non-payment has also soared in recent weeks, etc., blah, 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 blah. But never has this spread been so erratic.
Erotic.
What?
Erotic. 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 Erotic.
which means that the short-term debt markets are at least pricing in a possibility of a real default, at least a temporary one. In June, we will see what happens, down to $87 billion and counting. Here is a chart of the 1-month Treasury yields that is current to May 17th, morning May 17th, and we see it's up another 27 basis points this morning, and I'm speaking on the morning of May 17th. We're up to 5.82%. This is an all-time record high for 1-month yields. 1-month Treasury bills have only existed since 2001. They've never been this high, and everything's probably fine. There's nothing to worry about.
Please disperse! Nothing to see here, please!
Now, as for that myth that the regional banking crisis is happening because deposits are fleeing regional banks and moving to large commercial banks, that is not actually happening. I'm not saying it's not happening in any case, but it's not happening on net, because you can see here that this is the chart from Fred of deposits of large domestically chartered commercial banks. This is not the regional banking crisis. These are not those banks. This is big banks like Bank of America, JP Morgan, etc. So here I plotted the highest deposit level of these banks, which totaled $11,455.6409 billion on Wednesday, March 9th, 2022. We are down now. I think this is the latest data we have is for May 8th. Close enough. It's not May 17th, but whatever. This is a little bit old. Updated May 12th. $10,695.6868 billion. So if you take that math and you take 10.695 trillion over 11.4556 trillion, you have a loss of 6.6% in deposits. Now, if we move to the regional banks, you see here this big drop in March. That was the regional banking crisis. Still, if you take the numbers from March 9th, 2022, you have here at that point $5.44 trillion, and at the last measure updated May 12th, $5.247 trillion. So if you take 5.247 over 5.44 trillion, you have a 3.6% loss. Compare that to a 6.6% loss of deposits among the large banks, a 3.6% loss among the small banks. What is going on? Money deposits from both the large banks and the small banks are moving into reverse repos, moving into money market funds, moving out of the banking system, and defaulting from defaults on debt, which erases deposits. Now here I have a chart, which I've showed often, of registered silver in the COMEX, and we can see here that it has fallen for the first time since 2016 below 30 million ounces. Now this is something pretty impressive, because right at silver speeds, we're at 152 million ounces for sale of registered silver to be sold against paper futures silver contracts. 152 million, now we're down to less than 30 million. So if you do the math, we have successfully drained out of the COMEX about 120 million ounces of registered silver. That is something to behold, and the process continues today. I think a little bit more, a few 100,000 more ounces were drained off today. I'll do another video on this later to see if we can make any more progress on this, but this here is an all-time low in 2016. And now people tell me, yeah, there's no correlation between amount of silver and the silver price. That might be true, but when they run out of silver here, the silver futures market is going to be in trouble. And we see here that 2011, this May 2011 bottom here corresponded with a silver top. That was the May 2011 silver top at around 50. This, around the end of 2015, beginning of 2016, corresponded with a silver bottom when the gold and silver bear market of 2011 to 2015-16 ended. And now here, what is going to happen here? Are we going to go farther and farther down to a new record low? Maybe. But this is a big turning point in silver, and we're still at around $24, which is nowhere near a bottom or a top. So it looks like we have more further down to go here, and if we can get close to zero, that would be something. Who knows? We'll see. If we're in a monetary crisis, that is what was going to happen eventually. Now, this chart is from Bloomberg. They asked a bunch of people, what are you going to do if there's a default, if there's a debt ceiling default, or they stop paying interest on US Treasuries? Well, they asked professional investors and retail investors, and more than half of professional investors says the first thing they will buy if the US hits the debt ceiling is gold. 51.7% of professional investors said gold. 45.7% of retail investors said gold. There's a lot of upside to the precious metals if there's going to be a temporary default, and I don't think the financial system will be able to survive even a temporary default. Do I personally think a temporary default is going to happen? Actually, no, I don't think that. But I do think it's possible enough to report on it and to be careful about it, because if it does happen, there's not going to be enough time for you to get into gold. And all these people that are saying are going to buy gold if there's going to be a temporary default, they might not be able to get much. If that is what they're doing, you should have in your possession your positions and your portfolio and your physical. You should have what you need now and not bet on a default, or don't not bet on a default either. Just stay calm. And whatever happens, happens, because we know where everything's going to go in the end anyway. Now, people talk about what is going on in the gold market. It looks like a pullback. Yes, in dollar terms, it does. But that is actually true for the entire commodity complex. The dollar is showing some relative strength now because the dollar supply has shrunk massively since 2022, and that shrinkage continues today. And so commodities are in a temporary downtrend. But if you take gold relative to other commodities, you can see a bottom here in June 2022 and a very purposeful, steady, up and down bullish move here with higher highs and higher lows since November 2022. Up, move higher, higher lows, higher highs, higher lows, higher highs here again in March 2023, and then higher low again in around April 2023, and then higher high here at around 3.94.0. And now we're in another little correction here of gold relative to other commodities. So while commodities have been in a bearish trend for about a year, gold has been outperforming the rest of the commodities complex, as should happen in a world where the monetary substitute, the dollar, is slowly but surely dying. And at some point, it will be quickly dying by some trigger. Could it be the debt ceiling? Could it be something else? Could be commercial mortgages. Could be whatever the hell. It doesn't really matter what it is. Something is going to happen because the money supply is still shrinking. The dollar squeeze continues. And once some big mine goes off in the banking system and the Fed has to print again to expand the money supply, that will be the last inflation of this monetary system. When does it start? I don't know exactly, but it could be at any point now. In the meantime, don't bet the debt ceiling is going to be breached. Don't assume that it's not going to be breached. Have your positions, be responsible, be the parent in the room, be the adult in the room, and understand what money is, that gold is money, and the dollar is only gold's substitute. Am I hoping there's a default on the debt ceiling? Yeah, because I just want this to be over already, but if not, it'll be something else, and I have the staying power, as do we all, I hope, because that is why we're in this business in the first place. This is Rafi, the Endgame Investor. If you enjoyed this video, then sign up for a 2-week free trial of the Endgame Investor, or become my patron on Patreon, where I give a weekly biblical commentary on the monetary happenings of today's universe. It's fun. The last video I did was be a sieve, not a sponge. How to protect your kids from propaganda that they get in their schools. And what does this have to do with the Bible? Well, they'll have to become my patron and find out, which you can do for as little as $3 a month. See you guys soon.
I've tasted other cocos. This is the best.
What the hell does this have to do with anything?
That's it. You people have stood in my way long enough. I'm going to clown college.